a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about index concentration and some equal weighted ETFs. So the biggest market story of this year is the outsized role of the Magnificent Seven stocks in the market rally. These top seven stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta Platforms, and Tesla, now account for more than 28% of the S&P 500 index. And top 10 stocks now account for 32% of this index. And according to a Goldman Sachs note, the average over the past 35 years, the average weight of these top 10 stocks has been 20%. And during the dot-com bubble, this peaked at 25%. So you must have seen many comparisons with Nifty 50 stocks of 1972 and then the tech bubble, which burst in 2000. And many experts pointed out that these top stocks look too expensive. So are they too expensive? Yes, they are expensive compared to their historical valuations, but they are still not at the levels that were seen during the dot-com bubble. And I would like to point out that unlike the tech bubble, these companies, now the names that we mentioned, these are all highly profitable companies. They are cash rich, and their growth rates and expected growth rates and margins are about the double of the rest of the market. But yes, many investors, experts, analysts, they are concerned about index concentration because when you are investing in ETFs, you are looking for a diversified exposure. So many investors have been pouring money into the S&P 500 equal weight ETF RSP that we will talk about in a little bit. And in fact, we have seen somewhat broadening of the rally in the past few days. Many other stocks that and areas that were beaten down earlier that they have been outperforming. So equal weighted ETFs are getting more love from investors. Now let's take a look at some popular equal weighted ETFs. So the most popular one is by Invesco that I alluded to earlier as well. It provides, as the name suggests, equal weight exposure to the S&P 500 index. The ticker symbol is RSP. This ETF celebrated its 20th birthday earlier this year. So its inception was in 2003. And in fact, since its inception, this ETF has outperformed the market cap weighted S&P 500 index. And this ETF is pretty popular for 45 billion in assets. Of that, close to 10 billion has come this year itself, charges 20 basis points. If you want to learn more about this ETF, you can go to the quote page on Zacks.com. I did a podcast with Invesco. You can listen to that. You can read our research report articles, and using the link, you can go to Invesco webpage for the ETF. And this is what I was talking about. Since inception, this has slightly outperformed the S&P 500 index. If you look at the portfolio, you will get exposure which is different from the S&P 500 index's exposure. So instead of being top heavy in the technology sector, you get a lot of exposure to other sectors like industrials, like financials, and healthcare as well. Now the second ETF, and yeah, you can look at the holdings also, but all these holdings are equally weighted. So it's the same stocks as in the S&P 500 index, but they will be equally weighted at the time of rebalancing. Now let's take a look at the other ETF that I'm highlighting, the second ETF that I'm highlighting provides equal weighted exposure to the NASDAQ 100 stocks. So remember, earlier this year, the NASDAQ had announced a special rebalancing because the top holdings in the index, they were exceeding the weights indicated in the guidelines. And currently, the top 10 stocks in the NASDAQ 100 index account for about 49% of the total index. So if you want to invest in these stocks, you like these stocks, but you are worried about top heaviness, then you can look at this ETF, the first trust NASDAQ 100 equal weighted ETF. The ticker symbol is QQEW. This charges 58 basis points and has 2.1 billion in assets. Direction offers a similar ETF that also provides equal weighted exposure to the NASDAQ 100, slightly smaller and cheaper. But they both of them will deliver almost similar performance. Now let's take a look at the ETF, the First Trust NASDAQ 100 ETF, and this made its inception in 2006. And since inception, it has not beaten the let's look at the performance. It has not beaten the market cap weighted index. Here you can look at the performance. So since inception, the NASDAQ 100 equal weighted index is up about 11.35%. So it has outperformed the S&P 500 index, but it has not outperformed the NASDAQ 100 market cap weighted index, because we know over the past a little more than a decade, past 10, 11, 12 years, the mega cap, the technology giants have been doing very well. So that is why the NASDAQ 100 index, which is top heavy in those technology giants, has done much better than the equal weighted index. And even then, the equal weighted index has outperformed the S&P 500 index because of its overexposure to technology stocks. So this is currently about 40% exposure to technology, and then consumer discretionary and other sectors. Now, these ETFs are expensive compared to market cap weighted index, because you can get market cap weighted S&P 500 index exposure at 3 basis points. So because of these specialized indexing and more rebalancing required, these ETFs, the three that we discussed earlier, are more expensive. If you want to look at a cheaper equal weighted ETF, then this is one of the cheapest ones. By iShares, the ticker symbol is EUSA. It provides equal weighted exposure to large and mid cap stocks. Charges just 9 basis points, which is very reasonable for an equal weighted ETF, and has 600 million in assets. Again, to learn more, we can go to the quote page on Zacks.com, and using the link, we can go to iShares web page for this ETF. So, as I mentioned, it provides equal weighted exposure to large and mid cap stocks. If you look at the holdings, you will get the holdings which are similar to other broad market cap indexes, but sector exposure would be slightly different. Information technology, then industrials, financials, healthcare. In the top three sectors get almost equal weight. Now, looking at this, one more thing I wanted to show you in this particular ETF. So this has a P ratio of about 17.94 times. The market cap weighted S&P 500 index And this is apples to apples comparison because these are both products are by iShares. So the market cap weighted in ETF S&P 500 ETF currently has a PE ratio of 23.16. So equal weighted ETFs are much reasonably priced. So if you're worried about top heaviness, if you're worried about stretched valuations, then this is worth a look. And on the last side, I have the comparative performance of all these ETFs versus the S&P 500 and the NASDAQ. And the NASDAQ 100 is now up 50% year to date. The equal weighted NASDAQ products, they are up about 28%. The S&P 500 index is up about 23% now. The iShares equal weighted ETF is up about 13%, and RSP, the Invesco product, which has seen a lot of love from investors, is now up about 9% year to date. And earlier this year, that was the ETF was almost flat because only the top 10 stocks were outperforming. Others were basically doing nothing. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.